Bevin, there's something to be said about drinking tea in a park here in New York. If you strip it back to its basics, banking, and forgive me, banking's quite a simple business. You have institutions that go out and collect deposits, which they then look to lend on many times over to other members of the public or to companies. What drives, what determines how much credit can be extended are a whole raft of things. But one of the elements that is now having a constraining effect on how much credit can be extended is this thing called the LCR, or the Liquidity Coverage Ratio. Bevin, what is an LCR?
Well, it's a very important concept that's arisen after the crisis, of course. I mean, your statement about the simplicity of the business is true, that the old doggerel is 3-6-3.
What's that?
Borrow at 3, lend at 6, and on the golf course at 3. Obviously, there are a lot
that
of
doesn't exist now, does it? Surely, tell me it doesn't.
I think you can, back in the halcyon days, I think maybe a small country Midwestern bank that probably works, but certainly not today with all the complexity out there. The financial crisis caused a concern about liquidity. It wasn't so much a capital problem as it was a liquidity problem. Consequently, with the Basel III rules have attempted to address that. So LCR stands for Liquidity Coverage Ratio, which is the high quality liquid assets divided by the net 30-day capital flows from a particular institution. That sounds like a mouthful, and it is. The issues and the purpose of that is to make certain that the institutions have enough capital or liquidity to meet all of their obligations. The rules around how you determine the long-term capital, the high-quality liquidity assets can be very arcane. And one of the biggest problems that you have is in Europe, they have different rules than they have in the U.S. So this, I think we'll probably discuss it later, but this leads to a number of systems and infrastructure technology issues.
So that makes it a whole lot more complex.
Absolutely.
Why is it in the US that you've gone further than the Basel III requirements?
Some other events had to do with subprime mortgages and asset-backed securities. So you'll find in all of these rules, these are all constrained in some way. For example, no asset-backed securities are considered to be a part of high-quality liquid assets. So they are not allowed to be a part of that. I think that's, so you can map many of the most severe events in 2008 to rules that are in everything surrounding Dodd Frank and the Basel rules.
Okay, so in the US, you've gone further.
Yes.
And I guess it is section 165 of Dodd Frank? Is that what the OCC, the FDIC, and the Fed all point to in terms of governing how the LCR regime works?
That's correct, and also to a certain extent the Consumer Finance Safety Bureau also has regulatory oversight.
So if I could maybe, Bevin, just to help me understand this a little more,
sure.
Just sort of take a step back. The LCR regime and how Dodd Frank has been rolled out, it also seems quite complicated because there are different tiers of banks with different tiers of HQLA that have to be applied. Where are we on the timeline on that?
Well, obviously the top tier banks are having to respond to this first. My opinion is it's probably a moot point. I think ultimately these will trickle down to all of the banks.
How far down would that go, Ben?
Well, if you speak to people in the industry, you will hear that many of the regulators don't seem to care about institutions much below $10 billion. There's a belief out there that ultimately banking institutions below $10 billion will probably cease to exist, be merged. That's the opinion that some people have. So I think all the way down, all the way down to $10 billion ultimately.
Top tier banks are defined at what, 250? And then
second tier 50, and then 10.
Is there a time scale on which this is being rolled out?
It is, I think the top tier banks are obviously undergoing right now through those stress tests. I think we're 2 years away for the next tier.
From what I hear, there's a tremendous amount of work to comply. You've pointed to some of the difficulties with, I guess, top tier banks having transnational operations. But here at home in the US, where are the points of priority?
I would say that from a systems and operations standpoint, first you have to get your accounting straight, and that's a major issue to a lot of organizations. There's a difference between consulting books and records, the accounting books and records. If they have a proprietary desk, there's portfolio books and records. These are often, at many institutions, different systems, all of which need to be reconciled. And this is no small task at these large organizations. The next important component is the data warehouses. Large organizations can have many, many data warehouses. I mean, a friend of mine was telling me about a project he was on. There were 80 different databases involved for a large financial institution. These somehow have to be aggregated, probably using some technology, some sort of data hub technology. And then ultimately these have to be translated into a data lake or an overarching data warehouse.
So that's a new term for me, a data lake.
Yes.
Did I hear you correctly?
That's correct.
Help me understand that.
Well, I think it's one of those terms. It is a buzzword, and a data lake is intended to capture both structured and unstructured data. So structured data could be something from a relational database, and unstructured data could be something coming from a cell phone. But the concept is however you get there, whether it's one large aggregated database, data warehouse, or a data lake, you've got to get all of this information into one place so that you can write reports against it.
But Bevin, how's that possible? I mean, in my experience, whether it's top tier or tier 2 banks, I hope I'm not being unkind, but I think it's fair to say there's a lot of spaghetti out there with all sorts of legacy systems and disparate systems and bolt-ons. How does all this data join up?
That's an interesting question. I'm sure that there are a lot of people struggling with that right now. And that's probably if you want to talk about risks to the system, I think there are two. I don't think it's entirely clear to everyone what the rules are, and the fact that so many of these institutions are failing their stress tests indicates that there's some miscommunication there or lack of understanding. Once you figure that out, now you have to come up with the policies to meet all of these reporting obligations, and it's no small task. I suspect that some firms will probably have to merge in order to acquire the intellectual capital to be able to achieve these goals.
Do you really think that's a possibility, that the onus on the regulation is such that balance sheets companies banks are going to have to merge? I mean, that seems like quite a radical step. Is that the intent of the legislation?
Well, now you're speculating and asking me to speculate, which I'm happy to do. Yes, I think that's the interesting part of these regulations, are that there is an attempt to make the banks smaller and more streamlined, but then the regulatory requirements are such that it forces a larger balance sheet to be able to handle all of these expenses. So there's a contradiction there that I don't think anyone is not resolved yet. Probably won't be resolved anytime soon.
So the top tier banks are 1-2 years into the process already.
Yes.
Are there any key learnings that are coming out that perhaps the tier 2 banks could start picking up and as they prepare to become compliant?
I think some of the things we've already mentioned, these have to happen regardless of what we're talking about. The data aggregation is probably going to have to happen no matter what the size of the bank is. And all of the issues that you mentioned earlier about workarounds, bolt-ons, disparate systems, that you can be a pretty big, look, $50 billion in assets is not a small company. That's a company that probably has more than one database management system, probably more than one custody system, more than one accounting system. If you think every proprietary trading desk may have its own set of technologies, I don't think that's really going to change. It's just the scale of the endeavor, will be different.
I raise it only because you touched on it a little earlier in our conversation, but no country is an island into itself. We live in a global 24/7 markets. What are some of the practical issues then that come about with Basel III, Dodd Frank, and the need to cut back on LCRs?
Well, if you think about just the operational aspects, especially for think of these entities that operate in all these different time zones, at some point you have to cut the tape. Who makes that decision? What is the optimal way to do that? You can have disparate cash flows. Having the operational constraints in place to make certain that you don't fall below the 100% requirement for LCR, I think requires a certain amount of buffer that that the institution has to determine, and it would seem to me to be completely compliant on that requires a lot of operational constraints and controls, a lot of policies that have to be written. You really wonder, where is this magical person or team of persons that is providing all the intellectual capital to do this? I mean, you're starting to describe a pretty remarkable group of people. They have to know all these compliance rules. They have to know, bank balance sheet rules. They have to know a lot about transactions. And a lot of these businesses are still in a lot of different businesses.
So Bevin, we've covered a lot of ground. What's going through my head right now is an old saying, well, we are where we are, so there's not much that we can do about changing the way things are. We've just got to get on with it. So let me ask you to suspend your disbelief for a moment. Let's say that you're made the CIO or the CTO of a large US bank. What are the 3 priority areas that you would be focusing on Monday morning?
Might be more than 3, but the first would be there has to be some sort of overarching policy to develop the platform to support all of this, and that's a very tall order. I don't think that's quite a project in itself. The design of this platform has to be such that it's going to have to be very flexible, because these rules are constantly evolving. The 2013 version of the asset rules, excluded munis. Now, I think just a couple of months ago, certain munis will now be allowed on American balance sheets.
Right. As part of the HQLA definition.
That's correct.
Yeah.
I think that as time moves on, there will be political pressure to expand that list. Historically, the banks have been the major buyers of state and local paper in this country. So, there's another major disruption that we've encountered. So, just an example of how things are going to evolve, and the platform has to be able to handle that. We talked about assembling the right technologies. That is a very complicated issue. I can imagine a very high level at one of these bigger banks just having a very high level executive focusing on nothing but accounting systems, which you have to be able to account for all of these securities before you start putting them into a database such that you can write reports against it.
Are you talking about like some sort of chief data officer?
That's correct. I think they're operating under a lot of different names. I don't know who in their right mind would want that job. I've also heard that these guys are now making a lot of money for good reason because of all the risk that's involved. It's probably coming to be the most important job, or one of the most important jobs in the firm, which I think leads me to the larger overarching problem in the industry. Is I would guess it's highly unlikely that your average CEO at a bank who has many responsibilities is going to be conversant in all of these different disciplines, which is challenging. And there's not, to my knowledge, there's not a degree that would prepare anyone to do all of this. If you think of the different disciplines that are involved, and that, I guess, morphs into like the final, I think, challenge is the lack of communication between the different silos in these organizations. So for example, you've got the business people, maybe that's roughly the CEO. You've got the financial people, that's the CFO. You've got this, and this is a big leap, but let's say you put systems and operations together in one unit. Then you've always had the compliance people, which now have had their status in the organization dramatically increased. But at some of these larger organizations, I hear tell that the regulators actually have offices, in the senior executive suites and engage in a lot of these meetings actively. So if that's the case, and they're all speaking different languages, I won't say they have agendas, I guess a pejorative term, but you could say they have different agendas. They certainly have different terminologies. They have different backgrounds, and someone has to be able to assimilate all of that. And this ultimately has to get into a plan which is implemented through a technological platform. Very complicated issue, and you could see how you would think that this would encourage or force people to break these banks up into smaller entities. I'm not so certain that these problems go away. And then there's still a larger issue that I don't think anyone is addressing is we're in a global economy. We need big banks. I mean, there may be a lot of issues surrounding them, but just think about the nature of global commerce. How do you do this, without large financial institutions guaranteeing some of these transactions?
Bevin, we've covered a lot of ground today. Thank you for your time.